My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be with my friends. I'm just trying to make a little money. My job, not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Second day moves after a giant rally, they're always predictable and, yes, a little ridiculous. They're all about buying an amalgam of stocks that were missed on day one, or stocks of companies that just gave you a new reason to value them higher, and stocks that, upon further review, just like in a football game, can now be justified as worth owning. And that's exactly what led us higher today. As Dow jumped 164 points. S&P gained 0.16%. But the Nasdaq, so strong yesterday, advanced by just 0.07%. I think it's worth breaking down today's move because it shows how much people want to own stocks here, buy stocks here. They've just had trouble finding new ideas that fit a scenario where inflation is rapidly cooling and we're coming to the end of the Fed's rate hike cycle. Let's start with Target, and not just because you'll hear from CEO Brian Cornell later in the show, but because its stock was today's biggest winner, up a magnificent 18%. We all know there's been a relentless levitation to Costco, Walmart, and TJX, the three brick-and-mortar retailers that Wall Street still believes in, along, of course, with Amazon for digital. But money managers don't trust anything else in that industry, and Target specifically has lagged behind because it hasn't produced positive same-store sales. That's the key metric that defines real growth in ages. Target's seen as less of a bargain than the four big ones with higher costs and less differentiation than it used to have. Or at least that was the story heading into today. This morning, though, Target reported a quarter that showed bountiful profits, much better than expected, even as its same-store sales were still nothing to write home about, and its total revenue was only in line with expectations. Now, none of those negatives matter because the company had extremely lean inventories, down 14% year over year at the end of the quarter, meaning they weren't forced to discount lots of merchandise just to get it out of the store, and there was less of a theft problem than a year ago, while transport costs have finally returned to normalcy. Even with lighter sales, these positives are fantastic for gross margins, what Wall Street cares about, hence the huge earnings beat, and there should be a lot more of these kinds of quarters ahead. In response, the stock flew straight up, running nearly 20 points. How can that move be justified if Target only posted an earnings beat, not a big revenue beat as well? Simple. People are looking for laggards that perhaps shouldn't be laggards. They're looking for stocks that can play catch-up because they are excellent companies that maybe hit some rough patches. Target, for example, hit its high for the year back in the beginning of February. It's when it struck $181. Its all-time high of around $269 was set exactly 2 years ago today. Last night, it closed at $110. Walmart, on the other hand, traded in the mid-140s at the beginning of February, and now it's just under 170. TJX has gone from 80 to 89. Costco rallied from 500 to nearly 600. Amazon 100 to 143. See, big-time money managers look at those comparisons. Believe me, that's what they have on their desk, and they say, wow, is Target behind? Let's buy it now. Buy. And maybe it solves its sales problems. No matter what, it's a bargain relative to earnings. It's a bargain relative to other companies, especially if the Fed's done tightening. I think that is a compelling argument, really. Even up here at $130, it is a bargain versus the others. Of course, there are a host of other reasons why Target works here. 3.4% yield looks a lot more attractive if the Fed's not going to raise interest rates anymore by Treasury bond comparison. If inflation continues to cool down, consumers will have much more money to spend. And in the time since Target went out of style in the Wall Street fashion show, the company solidified its partnerships with Ulta for beauty products, CVS for drugs, and Starbucks for libations. Lots of these store-within-a-store concepts that make the shopping experience much more enticing. That coalition gives people reason to pay up for the stock when it otherwise might seem foolhardy. That's called second-day behavior. Here's another example. There's nothing like a foreign leader visiting the United States to get people to buy things. I doubt much will come from President Xi's visit with President Biden in San Francisco. But it gives you a whole new perspective on what some stocks that were left behind or even left for dead, stocks that will do better when the Chinese economy has a pulse. We had our monthly conference call for Investing Club today, and we had to mention that Estee Lauder has been a big loser for the Charitable Trust. But you know what? Estee Lauder does a lot of business in China. The stock had a big move yesterday in anticipation of the Chinese move and then followed it again with another rally today because it's one of the most behind-the-market stocks out there. See, back in February, Lauder traded at $280. That's when there was still hope that the China economy would come back online with a vengeance. When that didn't happen and instead we got a real estate collapse, Estee Lauder stock plummeted to 104 at its lows a couple of weeks ago. That's an astounding, almost unthinkable decline for such an iconic company with name brand management. Of course, we have no idea if anything good's happening here, but after that much capital destruction, it doesn't even matter. The stock had a second-day bounce written all over it, hence why it rallied another 3% today after a large run yesterday. Who else goes on a roll when China's back? Well, of course, that's Nike. Again, here's a stock that's terribly behind the market, even though any portfolio manager can rationalize buying it pretty much any day of the week. Remember, in this racket, the professionals are always trying to justify their existence and their high fees. They need to show value added. Buying some Nike off of a flaw, some sort of flaw in China, well, that works every time. Some stocks that bounced today fit several silos. For example, Disney stock's been on a tear since late October. First, the stock simply got too cheap. Was just beaten down. Then it rallied because the company reported a better than expected quarter, management announcing $2.2 billion in cost cuts on top of $5.5 billion they'd already committed to. Great streaming numbers, and they said the streaming business could be profitable by late next year, something that would further justify Disney's move to buy the rest of Hulu from Comcast, parent of this network. Now, Disney also has a huge and often forgotten about Chinese business that can only be helped by Xi's visit. Certainly can't hurt. Then today we learned that ValueAct, a stunningly good pseudo-activist hedge fund, is building a stake in the company. ValueAct has been an excellent source of outside ideas and could be a real catalyst for management. That maybe even includes finding a successor to current CEO Bob Iger. So we have a new reason to look at Disney, and we have news that justify paying for more. I'm calling that one a twofer. Finally, some stocks were simply forgotten about, and with inflation cooling, they can easily be justified as plays on a better economy that comes from lower rates and a friendly Fed. You know, the transports, they can always rely upon this in this environment. I think United Parcel, Union Pacific, FedEx. These stocks can be just slotted into your portfolio here, especially because we're near the holidays. Target's talking about buying newness. Lululemon's always new. Ralph Lauren's got newness. These work real well. They can't be proven wrong for the moment because there are no new data points that would possibly cause a glitch. Maybe they're foolproof through the end of the year. I want to emphasize that there is nothing wrong with this kind of thinking. I know I made it sound glib, but there's nothing wrong. I just want to teach you to anticipate this kind of thinking. And there is absolutely, let's say, fair play to notice the profit taking we saw in big cap tech, too, especially after this evening's disappointment in both Cisco and Palo Alto Networks reports. Now, we've got the CEOs of both companies on tonight. We got to find out what really happened, not the headlines, but what really happened, the bottom line. Today's session shows people are itching to get into this market in the worst way. And sometimes the worst way is to just knock on wood and buy anything that's falling behind. It's what you do when you've missed the big move. And if you are a professional, it's how you demonstrate why you are worth paying for. Robert in New York. Robert.
Jim, I got to tell you, you definitely have our back. And I have become pretty good at this by listening to you, number one. Okay?
Thank you.
I got to tell you this. I really do. I'd like to know if you are firm on Affirm Holdings.
Okay, I talked about this with Ben Stoto today, who works with me, research director, and we said without a doubt, I said, I think Affirm has turned the corner. They would say they never had to turn any corner. It's been a straight line. But I thought this quarter was a remarkable quarter, and they demonstrate how to be able to lend in what many people think is a dicier environment. Affirm's for real. All right. Today's action shows me that people are really itching to get back into this market, even doing it in the worst way, this second day by buying the laggers and hoping for a catch-up trade. Oh, man, buddy, tonight, three big stories. Target really hit the mark. Whoa, this quarter. Stock surging nearly 18% today. What drove the strength? I'm digging into the numbers, giving you a little preview about the holiday season. Then Palo Alto Networks reported the bell, and the street right now doesn't seem to know what to think other than maybe to sell. Let's talk to the CEO, figure it out. And Cisco plummeted this evening on the company's earnings report. Well, really much more on its forecast. And I'm making sense of what's going on here with the CEO, Chuck Robbins. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.